Hi, I'm Max Keiser. This is the Keiser Report. Well, let's get into it, shall we?
Hey, Max, I want to show you a hockey stick sort of chart. It's a good time to do it during the Stanley Cup. Well, 1 month Treasury bill yield. This is quite remarkable going back to 2009 to June 2018. You see that it has soared 91-fold from its low in June 2015 when it was 0.02%. Now it's 1.82%, a 9-year high. That's a remarkable 91-fold increase in the yield. It's on the 1 month Treasury bill. But
yeah, it shows that banks don't trust each other. So banks are not lending to each other, so credit is freezing. That's what a credit freeze looks like. We saw it in 2008, and then the global financial crisis ensued, and it required a $20 trillion worth of fresh central bank printing of money to bail out the banks, and then they used that money to increase their balance sheets and risk by a huge factor. And now we're at the stage where it's going to collapse all over again, but in a much more spectacular way. So that's what that's telling us. If that continues, then yes, we're on the verge of another leg down of the global financial crisis.
It did start, this soaring of the yield started right as Trump was elected. So the bond market is moving in one direction. Stock markets are booming, obviously, and that's done well under Trump. And part of it, and I'm going to get to that in a bit, is to do with all the share buybacks as well and Trump's new tax legislation, which has seen repatriation of overseas funds. So FANG shares hitting all-time highs as well. This is another chart from the same guy. Facebook all-time high, Apple all-time high, Amazon all-time high, Netflix all-time high, NasDaq 100 all-time high. You see they're doing quite well. Maybe the bond yields are not doing as well, but certainly the share prices are doing well.
Yeah, absolutely. The monopolies are alive and well in the platform stocks like Amazon and Facebook and others that dominate that space.
Yes. So those are all the big online social media platforms. They're all doing well, and they've been soaring, and the NasDaq is at a new high. The last time we saw it this high was back in 2000, right, when the dot-com bubble crashed, the last one. Now, is this sustainable? Is this not? Well, wolfstreet.com, they look at it, and, Wolf Richter over there does a lot of analysis of the housing market, of the auto market, of stock markets, of bond markets, and he says, he looks at what's overvalued, what's not, and he gives some reasons for it. So it's a good site. We've interviewed him many times. But his article here on these dot-com shares and their soaring valuations and the soaring stock markets, he's got an interesting explanation for this. Huge new prop under the stock market is a one-time affair. Crash insurance with an expiration date, but it's working while it lasts. In May, with great and perfectly orchestrated fanfare, U.S. corporations announced plans to buy back $173.6 billion of their own shares sometime in the future. It was the largest monthly buyback announcement ever, and some of the announcements were expertly timed to overcome operational debacles. So again, he's looking at their actual results. He sees a lot of operational deficiencies there that would normally impact the stock price, but they've timed these share buybacks to have huge announcements, biggest ever, 173 billion that were announced in May. Now 100 billion is from Apple alone. But they, as he points out, have not even finished. Apple Corporation has not even finished doing their last announced share buyback. So whether or not this will ever materialize is another thing. But a lot of this has to do with this repatriation of all their allegedly overseas funds.
Well, the problem is that, by way of analogy, if I had a convenience store that sold lots of stuff in that store, and my revenues that I reported at the end of the year were based on myself buying the stuff in my own store. So at the end of the year, I said, I bought all the toilet paper, and I bought all the Twinkies, and I bought all the antifreeze, and I bought all the Twizzlers, and I bought all the beef jerkies. I bought all that stuff. And I booked huge revenues. Okay, that's great. I should be worth a lot of money because of all the revenues that I have created by buying back all the stuff in my store.
You should be in the government.
Well, that's what happens when you're buying back your own stock. Yeah. You're not creating any earnings.
Well, in the last episode, you were talking about the collapse of the Soviet Union and the United States would not be far behind. That, of course, sounds like a Soviet model, a communist model, is just buying back your own stock. Now, would Steve Jobs have done this? I mean, would he be buying back $100 billion? Couldn't he find a better use for $100 billion? If it's $100 billion buying back your stock, sure, great, your shareholders are very happy, but is the future, does that future look bright if you can't find anything to spend it on?
You're creating short-term gains at the expense of longer-term growth.
Yes.
Essentially. So you're not, instead of investing in the future and in products and in employees, you're taking all that future revenues and you're booking it today. So just like the man who's buying back all the stuff in his own store. Yes, he bought back all of his stuff in his store and he has a lot of revenue, but now his store is empty and he has nothing to sell. So the next quarter, he says, my sales are zero because I have nothing in the store to sell. I bought it all myself. So similarly with Apple, they'll buy back all their stock. They won't invest in the future. And when it comes time to report earnings in a year or two from now, they'll have nothing to report.
Well, I'm going to get into why this is basically just a blip because of the tax legislation that Trump passed. But,